Welcome back. If you feel like the floor just fell out from under the world, you aren't alone. In the last 48 hours, the precious metals market didn't just correct, it suffered a mechanical heart attack. We are looking at over $7,500 billion in paper wealth evaporated across the global commodities and equity landscape. Gold, which was sitting comfortably above $5,500 an ounce, just plummeted 10% in a single gut-wrenching session. Silver? A total bloodbath, crashing 35% from its recent peak of $121 down to the mid-$70 range. But here is the deep dive truth. This wasn't a change in fundamental sentiment. This wasn't because people suddenly lost faith in hard assets during a global war. It was a liquidity black hole. As the CME Group hiked margin requirements by over 30% in just 3 business days, over-leveraged institutional traders were forced to liquidate. We saw what analysts are calling a gamma squeeze in reverse. When the biggest safe havens on the planet become the most crowded trades, the exit door simply isn't big enough for everyone to leave at once. This is the great repricing of 2026, and the physical market is now violently disconnected from the paper price. What we are witnessing is the ghost of liquidity haunting the vaults. For years, the paper-to-physical ratio has been stretched to a breaking point, sometimes exceeding 400 to 1. When the margin call started ringing at 3 in the morning, those paper contracts were dumped onto a market with no buyers. $7,500 billion represents more than just a number. It is the destruction of the world's primary collateral. If you look at the Bloomberg terminal data, the bid-ask spread on silver is currently wider than during the 1980 Hunt Brothers collapse. This is institutional panic. The big banks are protecting their own balance sheets by pulling the plug on the retail investor. Why did it happen now? Because the volatility in the bond market has made it impossible to price risk. When the 10-year Treasury yield spikes 50 basis points in a single afternoon, every computer model on Wall Street screams, sell. They sold the gold to save the house. They sold the silver to pay the bill. But look at your local coin shop. Is gold actually down 10% there? No. Premiums have surged to 40% over spot. The spot price has become a fiction, a ghost price generated by a dying paper system that no longer reflects reality. This is the first stage of a systemic reset. We are moving from a world of infinite paper to a world of finite reality. The shockwaves from this $7 trillion wipeout are hitting the pension funds next. When you lose that much value in the safe portion of a portfolio, the forced selling cycle begins its second rotation. We are only 3 minutes into this crisis, and the clock is ticking toward a total freeze of the global clearing systems. If you thought 2024 was volatile, 2026 is proving to be the year that the math finally caught up. Stay tuned, because as the smoke clears from the trading floors, we have to look toward the horizon where the oil fields are literally on fire. While Wall Street was counting its losses in the paper pits, the horizon of the Persian Gulf began to glow a deep, ominous red. On March 18, 2026, the regional shadow war officially escalated into a direct kinetic confrontation that has sent shockwaves through every gas station. This wasn't just a minor skirmish, it was a coordinated strike on the literal jugular of the global economy. Following the Israeli precision strikes on the South Pars gas field, Iran launched a massive retaliatory swarm of drones and ballistic missiles. Multiple Iranian-made drones successfully bypassed air defenses to strike the SAMR-EF refinery in Yanbu, Saudi Arabia, causing a massive explosion. This facility is a critical joint venture, and its temporary shutdown has instantly removed 400,000 barrels of daily capacity from the market. In Qatar, the world's third largest exporter of LNG, the Ras Laffan terminal is reportedly facing extensive damage after the recent attacks. This single facility is responsible for nearly 20% of the global LNG supply, leaving energy markets in a state of panic. With fires still burning and tankers being rerouted around the Cape of Good Hope, the market is pricing in a permanent disruption. Brent crude oil didn't just tick higher, it exploded 40% in a single week, blowing past $116 per barrel. Now, you might be asking, if the world is on fire and oil is skyrocketing, why did gold and silver just crash? This is the liquidity paradox of 2026. When energy prices spike this fast, it creates what economists call inflation persistence. In response, the Federal Reserve, led by Chair Kevin Warsh, has just delivered a message that chilled the heart of every precious metals bull. They have signaled that interest rate cuts are completely off the table until at least June of 2027. In a world of $116 oil, the Fed cannot cut rates without risking a total currency collapse. Institutional funds are dumping their gold and silver contracts to chase the soaring yields in the energy and chemical sectors. Refining gold and silver is an energy-intensive process. As electricity costs triple overnight, the cost of converting raw ore is skyrocketing. We are seeing force majeure declarations from major refiners. They simply cannot guarantee delivery when the power grid is failing. The wipeout we discussed was the financial tremor. This energy crisis is the tectonic shift dismantling the just-in-time energy world. Is this a repeat of the 1970s, or is the ghost of 1929 finally knocking on our door? The narrative you're hearing across every financial news network right now is a single terrifying phrase. It is 1979 all over again. But as we peel back the layers of this advanced economic collapse, we have to ask, is that comparison a warning or a massive understatement? In 1979, the world was rocked by the Iranian Revolution, a doubling of oil prices, and a decade of stagflation. That stagflation broke the back of the American middle class. Fast forward to March of 2026, and the parallels are not just eerie. They are magnified by a factor of 10. Once again, we have a hot war in the Middle East threatening the world's vital energy arteries. Once again, we have a Federal Reserve that spent years being far too accommodative, only to be forced into a corner by a supply shock. But here is where the deep dive reveals a much darker reality. In 1979, the US federal debt was 33% of GDP. Today, in 2026, that debt has surged past 120%, recently crossing the $39 trillion milestone. This is the debt trap that Paul Volcker didn't have to face. In the late 70s, Volcker could raise interest rates to 20%. In 2026, if Chair Kevin Warsh tried to move rates to even 8 or 9%, the interest would consume the entire budget. We are facing a stagflation depression, a toxic cocktail of 1929's stagnant growth and the energy-driven inflation of the 1970s. While the official CPI is reported at 4.8%, the shadow stats, including gas and heating oil spikes, are screaming double digits. Unemployment is quietly creeping towards 6% as small businesses buckle under the weight of high borrowing costs and electricity bills. We are seeing a wage price spiral in the service sector. But unlike the 70s, there is no industrial base left to absorb the shock. So, why did gold and silver crash in the face of this? Because in the 1929 portion of this crisis, cash is king. When the stock market margin calls start hitting, big funds sell their winners, gold and silver, to protect their losing bets. The great liquidity flush of 2026 is a desperate scramble for US dollars to pay down debt repricing at much higher rates. We are watching two historical disasters collide in real time. The 1979 energy shock meeting the 1929 credit collapse. The result isn't just a recession, it is a fundamental breakdown of the global monetary order. Paper wealth is vanishing into the ether. As the physical refineries have gone dark, we will look at what this means for the end game of your personal wealth. The only thing more expensive than oil is the truth about our financial system. Stay tuned as we conclude this analysis. The most terrifying part of this deep dive isn't the flashing red numbers on your smartphone, it is the silent breakdown of the physical infrastructure. As we stand here in late March of 2026, the primary gold and silver refineries have effectively gone dark. This is the end game of the liquidity crisis we have been tracking. When market volatility hits 50% in a single week, the bid-ask spread becomes so wide that the world's largest refiners in Switzerland and Dubai cannot safely hedge their risk. In response, they have done something unprecedented. They have stopped buying. If you were to walk into a professional bullion dealer today, you'd find stasis. While the paper price might show silver at $71, try finding a reputable dealer willing to pay you that in immediate cash. They can't because they have no way to offload that metal to a refinery that is currently under force majeure. We are seeing a phantom price on Wall Street and a survival price on Main Street. The driver of this freeze is energy and collateral. With the Persian Gulf in flames and electricity prices in Europe reaching vertical highs, purifying ore into fine bullion has become prohibitively expensive. At the same time, the $7 trillion wipeout has drained the repo markets of the collateral banks use to lend to industrial giants. Without credit and without affordable power, the supply chain simply snaps. So, what is the end game for the individual investor? We are moving into a period where price matters significantly less than possession. The lessons of 1979 and 29 have merged. In a systemic reset, counterparty risk is the only metric that matters. If your wealth exists only as a digital entry, you're learning a lesson. The great repricing is not just about assets getting cheaper. It's about realizing paper promises cannot heat a home or power a factory. As the Federal Reserve maintains its hawkish hold, the window to transition from at-risk paper assets to physical assets is closing. We are heading into a second quarter that will likely see the first meaningful failures to deliver on major commodity exchanges. When the institutional players realize vaults are emptier than suggested, the crash in paper prices will be replaced by a vertical moonshot. This is the final transfer of wealth. It is the move from the great illusion to the great reality. Make no mistake, the fire in the Gulf and the crash on the COMEX are two sides of the same coin. The era of cheap energy is over. Your next step is no longer about timing the bottom. It is about ensuring you aren't left holding paper when the music finally stops. Protect your family, secure your collateral, and prepare for a 2026 that history will remember as the year the paper world finally burned. Want more? Share and hit subscribe for daily updates.